Hey guys, Joe Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look at a couple of trade ideas that I'm currently monitoring. Let's start off here by looking at the S&P 500, or this is at least a CFD that tracks the price of the S&P 500 future. And as you can see here, prices are actually sort of squeezing up within what appears to be a ascending triangle. Now, ascending triangles generally are bullish formations that form ahead of a breakout. So, like at the top of the triangle, you have a resistance area, which in this case is around 4,200. And then you also have this squeeze up of the lowers getting higher, of the lows getting higher, excuse me. And that appears to have been the case in the last couple of weeks. Um, so, a lot of people are very bearish on equities at the moment. Could we really get a break higher? Well, I mean, the earnings season's just got started. What we've been hearing from the banks so far, it's been a bit mixed, but regarding fears about a bank crisis, it's been probably pushing back against that idea, you would say, from at least the major US banks. We've got a lot of regional banks out this week, and we need to monitor that as well because those regional banks are actually much more the ones that are in stress. Um, You've also got US economic data turning for the worse, but at the same time with that, as the economic data gets worse, markets are pulling back on their Fed tightening expectations. Like we're only expecting one more rate hike from the Fed next month, and then for a rate cutting cycle to begin later this year. And that's despite, by the way, the fact that Fed speakers that we've been hearing, like so far this week and all for the last couple of weeks, have been more hawkish than that, talking about possible multiple further rate hikes and pushing back against the idea of rate cuts. But the market's view at the moment seems to be that the data is going to force the Fed's hand, and they're kind of living in fairyland at the moment, potentially. So, yeah, I mean, if the earnings season continues to go fairly well, if narratives about the Fed moving towards a rate cutting cycle later this year remain, there is the potential, I think, for a break above this sort of short term. Well, I wouldn't call it short term. It's been nearly 3 months we've been in this pattern now, but a push above this medium term ascending triangle that we perhaps are forming, and a push towards the August 2022 highs in the 4,000 or above 4,300. That's a possibility. Of course, this 4,200 area could quite feasibly show up to actually have just been a um, a double top before another leg lower, because historically the truth is that equities don't bottom ahead of a recession. Equities bottom or ahead of a Fed rate cutting cycle. Equities normally bottom when the Fed's rate cutting cycle is quite advanced. So that knowledge is keeping a lot of people sort of bearish and selling into rallies for now. But the technicals are still looking pretty nice if you ask me. Like we had this downtrend from 2022, which we broke above, retested, fake breakout back below it, but then we've sort of rallied from here, and those technicals are nice, man. Like these technicals are making it look like we could potentially even go higher than the August highs. But yeah, just trading what you see at the moment. Um, Similar story perhaps with the Nasdaq. You can see it's in an uptrend channel, which I've got drawn up here. It's been finding support nicely. It's 21-day moving average recently. Bit of an ascending triangle as well. These lows getting higher, and in the 13,200 area, that's resistance. And if the S&P 500 pops higher, well, you'd assume that there'd be a little pop higher in this index as well, which a lot of the big tech firms that make up the Nasdaq 100 have massive constituents within the S&P 500 as well. Um, we did have a pop higher in yields in the last couple of days, but like I say, if the US economic data is turning for the worse, if a recession is on the way, if a Fed interest rate cutting cycle is on the way, this little pop higher that we've seen in yields in the last couple of days or weeks is probably not gonna last. I would think the general direction that you would expect would be lower rather than higher, unless we've completely misjudged the US economic outlook. Maybe there's going to be no recession, inflation's going to remain hot, and the Fed's going to be taking interest rates still to the mid 5% area. Um, And if that is the case, then there could be a lot more upside. I just don't think that's going to be the case. Same story with the 10-year, by the way. It was forming this little descending triangle, which you would typically see a downside break of, but we actually saw this little pop higher. But yeah, same as the 2-year yield, I do expect this to keep moving lower. And if these keep moving lower, that should be supportive of the Nasdaq. That should be supportive of gold, which is also, I mean, maybe that's not the best upwards trend channel, but it's finding nice support. Its 21-day moving average certainly seems to be. I think you could draw a short-term trend channel here, actually, something like this. Boom, and here we seem to definitely be on the fast lane to a retest of the all-time highs, which are in this sort of 2070 area, having found good support at 2000, bounce from the 21-day moving average. You would think that the Dixie will probably continue heading lower as well if yields reverse, and we are in this little trend channel, although we did find decent support at the annual low, could be a double bottom. But, you know, the outlook that I've outlined, worsening US economic data, heading towards a recession and a Fed rating cutting cycle, if that is how things go down, we're going lower. I mean, never say that with certainty because there's always a chance that things get bad elsewhere in the world, and then the safe haven bid for the dollar comes in. But assuming that there is divergence between central banks, divergence between economic growth, then you would expect the Dixie to go lower. In terms of what we're looking out for the rest of the week, well, there's not too much out of the US really. I mean, there's lots of Fed speak. They've all been quite hawkish and not actually impacting the market. I guess you could say weekly jobless claims data is always in focus. The Philly Fed Manufacturing Index is going to be closely watched after the Empire State Manufacturing Index out of the New York region came in way stronger than expected earlier this week. We're going to see if the Philly Fed can match that. We're not expecting it to. Everyone's expecting it to still remain highly negative. And then there's these flash PMIs out of the US on Friday as well, which will, of course, update on the economic outlook as well. But a lot of the action's happening outside of the US. Like you can see here, we had this mixed Canadian CPI report. We had a mixed UK jobs report, although actually the pound was generally higher because of this strong, very, very strong, actually, earnings growth figure, which is people are interpreting as keeping the Bank of England odds on for another interest rate hike. You had some kind of weak data out of the EU or out of Germany at least anyway. But this data tends to be a little bit all over the place if you take a look at the chart here. It can jump a lot to the upside or to the downside of expectations on a month-to-month basis. The general trend is that pessimism isn't as bad as it was last year. But anyway, in terms of what we've got ahead, UK CPI tomorrow. That's going to be interesting. New Zealand CPI as well for the Kiwi traders. Then Eurozone, UK flash PMIs, UK retail sales, Canadian retail sales on Friday. So yeah, for the G10 focused people, currency people, a lot to be thinking about. But for the people that are more focused on just broader macro narratives in the US, it's a little bit less quiet. But yeah, guys, hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.